Hey everyone, welcome to this week's stock and macro update. This week I'm going to once again do stock and macro updates on Wednesday and Friday just because there's so much going on between earnings, GDP, rate hikes, jobs data. There's all kinds of stuff going on right now. And frankly, there's just way more to write about in stocks and macro than there is in crypto. Next week, though, I should be back to stock and macro updates on Wednesday and crypto updates on Friday. But this week, I want to go ahead and get started with a performance review for our 21 Disruptors Index, and then I want to get into 5 companies in that index that reported earnings within the past week or week and a half, and just go over what they reported and things that I'm looking at for each company. So, starting off with the performance review, the Disruptors Index was up 4.08% over the past week, beating the S&P, which was up 3.18%, and the Nasdaq, which was up 0.92%. And trailing the Russell 2000, which is the small cap index, up 6.16%. A lot of small cap energy companies that are really doing their job to prop that up. And then ARKK, which is growth stocks, up 6.69%. So small caps and growth still seeing some solid demand here. The Russell 2000 has actually been pretty surprising, outperforming the S&P by a good amount these past couple weeks. So that is definitely something going on in the market right now. The top 3 performers from the index: Teladoc, TDOC up 23.35%. That was the top performer. Number 2, Enphase Energy, which is ENPH, up 21.83%. Number 3 was actually Ethereum, up 19.96%. The bottom 3 performers: Airbnb, the ticker is ABNB, and that was down 10.87%. Trade Desk Inc., TTD, which was down negative 6.48%, and then Uber. I know they reported on actually just yesterday morning, so this does not count that gain. But Uber over the past week, as of Monday's close, was down 5.17%. So a good week from the companies that we have that reported earnings. Teladoc and Enphase were both in there. Pinterest was actually number 4 in the top performers after Ethereum, and that one also had a big jump after reporting. So definitely good to see from the companies seeing that boost from their earnings reports. And again, I want to get into 5 of these companies. The first one is Cadence Design Systems. So this is the company that a lot of people, I think, overlook. They kind of fly under the radar, but they actually create the systems that are used to design and test all kinds of prototypes, models for all kinds of electronic products, even ranging from the smallest kind of integrated circuit, microchips, semiconductors, all the way up to simulating really complex molecular design structures. And so they are really a huge part of innovation. They really enable companies to innovate. A lot of companies don't really, or a lot of people don't really see the companies working behind the scenes like Cadence, but they are definitely crucial to the innovative process. Their sales were up 20.2% year over year. Their earnings per share was up 32.5%. But more importantly, actually, their operating margin was actually up from a year ago, up to almost 29% from about 27.5%. Which is a solid jump over the past year, while a lot of other companies are seeing their operating margins actually go down pretty substantially for the past 2 or 3 quarters. Their profit margin was down a little bit due to higher taxes, but other than that, I thought their earnings report looked great. Some of their smaller divisions of their business saw 30+% growth over the past year. So they do have some high growth, smaller components to their company as well, which is something you definitely want to look for in growth stocks, because once the segment of your business gets big enough where it makes up a majority of your sales, just economies of scale, it starts to decline at the rate of growth of the sales that it brings in. So you want those smaller, higher growth parts of your business, and you want to keep innovating and creating more and more value by having these smaller high growth parts. So again, relatively high margins, which is great in this type of economy where we're seeing operating margins across the board pretty much go down. And the few exceptions, obviously other than like oil and things like that, are some of these tech companies. So that is great to see. Another example of that would be Enphase, and they were another one that reported earnings. Their sales, and these numbers are crazy, their sales were up 80.56% year over year, EPS up 108.33% year over year. Their operating margin more than doubled year over year from 10.63% all the way up to 21.34%. So while many companies are seeing margins shrink, Enphase actually doubled their operating margin, which is pretty crazy. Their total microinverter shipments, and that is kind of a component that just goes into a solar panel and makes more use of the sunlight that the panel brings in. Their shipments of those components actually went up about 30% quarter over quarter, which is crazy. The total megawatts or capacity of their batteries went from 1,213 megawatts to 1,709 megawatts quarter over quarter, which is 41% growth. So year over year, their sales are growing 80%. Quarter over quarter, shipments of two of their biggest products were up 30 and 40% in the past quarter alone. So the supply chain issues kind of hit Enphase and lasted longer than most other companies just because China is a huge player in the solar industry. They make pretty much all of the small solar components that are used all over the world. So Enphase has been having to deal with the Chinese zero COVID policy, where parts of the country have been in and out of lockdowns really for almost 3 years now. So this quarter, or Q3, was a huge, kind of relaxation of those policies for the places that Enphase gets their products. So they were finally able to meet some of that demand that's been bottlenecked by the supply chain issues. So that was great to see in Q3. And this is, I think, just a preview of things to come, because as the COVID policies get easier, it's going to mean really, really good things for Enphase as they can smooth that out. And also, they are looking to expand their production facilities into Europe and the U.S. going forward too. And especially the U.S. is important just so they can have more local supply chains, and they wouldn't have to rely on issues that have come up in global trade over the past 2.5 years. Next, Teladoc. So everybody knows Teladoc. They are the telehealth company. Beaten down, crushed. I think they're down 90% or maybe even more from the top in 2021. And I think a lot of this is actually unfair. I think it's been one of the most mistreated stocks in the entire market, actually. And I'll get to that in a second. But their sales were up 17.2% over the past year. Their free cash flow, levered free cash flow, which is their cash inflow after paying all their financial obligations, was $73.7 million in the quarter. And they've had positive free cash flow pretty much every quarter recently. They also have now 57.8 million paid members on their service. Last quarter, they said they expected 56.5 by the end of the year. They've already surpassed that by 1.3 million customers or paid members, so that is definitely great to see. Their gross margin, which is their sales minus their immediate cost of those sales, was up to 69.64%, which is a 4-year high for Teladoc. So gross margin improved, operating margin still getting hit, and that is a lot due to their goodwill impairment charges. So at least in 2022, a lot of the reason that Teladoc has seen a lot of pain in its stock price is because they wound down their overall goodwill value. And goodwill basically is an item on the balance sheet. It's listed under your assets, and it's the overall value of things like trademarks, logos, brand power, things like that. So intangible things can be very, very subjective. And so usually people don't like to see high goodwill or intangible asset amounts on the balance sheet. This is the one weakness that Teladoc had, and they actually have been reducing their goodwill over the past 6 months or 9 months now. But the first 6 months of the year, they reduced their overall goodwill value by $9.6 billion. So that had a huge negative impact on the stock. Basically, they were saying the value of those things had a shorter life, first of all. So the brand, instead of being billions of dollars for the next 15 years, they said it's only for the next 7. and they just said it was worth less in general because of the falling stock price was the reason that they gave. So the goodwill impairment charges were not only took a toll on their assets, but also took a toll on their expenses because it's a non-cash expense, meaning you don't necessarily pay for it out of pocket, but it does add to the expenses on their income statement, which is bad for their margins. So they are still dealing with that, but I think the pain of the whole goodwill situation is in the past because in Q3 they barely reduced their goodwill at all, and it's down I think like 70% below what it was at the peak at the start of the year. So I think that Teladoc from here on out is an amazing value. They're only worth about 2.1 times their past 12 months worth of sales in their market cap. So again, in other words, the total value of all their stock outstanding is their market cap, and that is only like 2.1x their past 12 months worth of sales, and I think 1.8x their predicted 12 months of sales going forward. So very cheap valuations for a company growing like Teladoc, exceeding their own expectations in sales and also in paid members. And yeah, they've got a pretty sizable market share in their field too. So I still think Teladoc is going to see much, much better days ahead. And these prices, while they have been persistently low, I think we're going to make our way out of this sooner rather than later. Next, Cameco. This is one of our uranium plays, and I actually did an update a couple weeks ago on this company, but just want to reiterate what they said during their earnings report. So in Q3, and their sales I think were down a couple percent year over year. Their EPS was down, and it's the future of Cameco is the reason to invest, not the current numbers. So as we're going to see, Cameco has an extremely exciting future. They've got a ton of demand for their products going forward, and we're still making our way out of this whole uranium nuclear bear market. So it's not reflected in their financials yet, but I think it's going to be for sure over the next year or so, and even more so after that. So in Q3, they added 5 million pounds worth of uranium contracts, which is quite a bit, and that is despite prices of uranium being at historic levels. So they now have 50 million pounds locked into contracts over the next 6 years, and they have another 27 million pounds worth of deals in the works for long-term uranium supply contracts. So that's 77 million pounds of uranium altogether that's either currently locked into contracts or is basically the step before being complete. And for reference, global production of uranium last year was about 138 million pounds. So they've got like 60% of a year's worth of global production already pretty much guaranteed to sell in the next like 6 to 10 years. So they're in excellent shape from a supply standpoint. And as demand increases, we see countries like Germany, Japan, France, even the US now increasing their interest in nuclear, bringing nuclear back really. So the price of uranium is going to skyrocket because none of these companies have really increased production all that much yet. They're very reactionary and conservative. So they want to make sure the demand is there before they start to increase production because it's very expensive to do that and to bring mines back online that have been shut down and just kind of maintained for when the next bull market comes. So Cameco has a couple big mines that are in that situation, even in the U.S., which is important because I think the U.S. is really trying to get uranium mining back, and Cameco is going to benefit from that. They just want to make sure the demand is there. They're now seeing that demand there, so it's probably not going to be too long before they bring more capacity online. But until then, and even after that, the price of uranium is probably going to go up more and more over the coming years. And Cameco is already locking in a ton of supply agreements with really, really high prices of uranium. So that's a lot of guaranteed revenue going forward. It's going to be very, very reliable streams of revenue for them. So very bullish on uranium, nuclear, and Cameco. Last one is Pinterest, and this is a company that's kind of undergoing a transition. Their monthly active users were up 2.8% quarter over quarter. That number doesn't really do it justice. That actually equates to 12 million. So they added 12 million new users, which is quite a bit because their users have been plummeting for like a year and a half now. So it was very good to see that. Their average revenue per user was also up. So not only did they add the 12 million users, but they also are getting more sales per user. That was up 1.3% quarter over quarter and 10.6% year over year. So Pinterest got a new CEO like 4 months ago, and he came in and wanted to make some pretty big changes. The main one is they want to make it more of like an individual experience. They want to tailor things more to each specific user rather than have a big kind of generic platform for everybody to use in the same way. So that's obviously going to take a decent amount of spending, but there's obviously pros and cons to that. It's good, and it's good because we're seeing that already have an effect with the added 12 million users and the average spend per user going up. But it's bad because they are spending more. That can deteriorate their margins. It already is. Their operating margin was negative 10% because of these higher costs. But on the flip side of that, Pinterest is probably one of the best companies that in terms of being prepared for having higher costs, because pretty much all of their assets are cash, and they hardly have any liabilities at all. They've had 7 straight positive cash flow quarters, well into the positive, like tens of millions of dollars, if not hundreds, per quarter. They've got tons of cash. They've got $2.67 billion in cash, which is over 5 times their entire amount of liabilities. So they really are not in any bad financial situation at all. So the cash flow for growth companies, I think, is more important than profitability, and that is because a lot of the things on the income statement, like expenses, are not necessarily as meaningful as, bringing in cash that you can stash or fund your operations with to grow your company. That's really the fuel for growth companies is cash. Pinterest has a ton of it, so I don't think they're going to be in any financial pain anytime soon, and they continue to bring in more. So yeah, their free cash flow continues to be positive, which is very, very, very important. So whether or not they're profitable in the next year, I don't think is nearly as important. If they're growing their revenue, they're growing their members, and they're growing their revenue per member, and they're consistently bringing in positive cash flow, that's exactly what you would want to see in a growth stock. So that is the recap for earnings for this week. I'm probably going to do a little bit more on Friday, so keep an eye out for that, and then probably more next Wednesday as well. But that is it for today. So thank you so much for watching, and I will see you again on Friday.